Understanding REITs, types, investment strategies, and key considerations. Real estate investment trusts, REITs, offer an accessible means for investors to enter the real estate market without the need to directly purchase, manage, or maintain physical properties. They have gained immense popularity, with more than $4.0 trillion in commercial real estate owned by these trusts as of 2024. Understanding the types of REITs, their market share, investment strategies, and potential risks is essential for anyone looking to add real estate exposure to their portfolios. Types of REITs and their market share. 1. Equity REITs. Market share, 96% in 2023. Description: equity REITs own and operate income-producing real estate properties. They generate revenue primarily through leasing and renting space. Examples include residential properties, office buildings, shopping malls, and hospitals. 2. Mortgage REITs. Market share, 4% in 2023. Description: mortgage REITs provide financing for income-producing real estate by originating or purchasing mortgages and mortgage-backed securities. They earn income from the interest on these loans. 3. Hybrid REITs. Market share, negligible since 2009. Description: hybrid REITs combine both equity and mortgage REIT strategies by owning real estate properties and holding mortgages. How to invest in REITs. Investing in REITs can be approached from various angles, with several methods available for attracting funding. Publicly traded REITs. These are the most common and easiest to invest in, as they are traded on major stock exchanges. They are highly regulated by the U.S. Securities and Exchange Commission, SEC, providing investors with a sense of security. Public non-traded REITs. These REITs are registered with the SEC but do not trade on public exchanges. This also makes them less liquid, however, they may offer greater stability as they are less influenced by market volatility. Private REITs. Private REITs are not registered with the SEC and typically cater to institutional investors. While they may offer significant returns, they come with higher risks and are more susceptible to fraud without the regulatory oversight found in public REITs. Investors can also find REITs incorporated in mutual funds and exchange-traded funds, ETFs, within their retirement plans, further providing diversification. Tips for starting to invest in REITs. 1. Begin with publicly traded REITs. Start with easily accessible options like publicly traded REITs. Research their portfolio, management, and debt before investing. 2. Start small and scale up. Consider beginning with smaller allocations in your portfolio, 2% to 5%, and gradually increase your investment as you become more familiar with the market dynamics. 3. Diversify across REIT categories. Different sectors such as commercial, residential, and healthcare have unique risks and opportunities. Exposure to various real estate types can mitigate risks. 4. Invest in REIT funds for more diversification. Consider REIT mutual funds or ETFs for instant diversification across numerous REITs, minimizing individual asset risk. 5. Explore real estate index funds. These funds passively track real estate indexes, providing low-cost access to a broad range of properties, such as the Vanguard Real Estate ETF, VNQ. 6. Be tax-savvy. Keep in mind the tax implications of REIT investments, as dividends are typically taxed as ordinary income. Utilizing tax-advantaged retirement accounts can enhance your returns. 7. Stay up to date. Real estate markets are influenced by broader economic factors. Staying informed about interest rates, inflation, and demographic trends can help you make more informed investment decisions. Advantages and disadvantages of REITs. Pros. Liquidity. Shares in REITs are relatively easy to buy and sell. Diversification. Investing in real estate offers a hedge against market volatility. Stable cash flow. REITs often provide dividends, generating consistent income. Cons. Low growth. REITs must distribute 90% of their income, limiting reinvestment potential. Dividends taxed as regular income, higher tax implications for investors, especially in higher brackets. Subject to market risk, REIT valuations can fluctuate with economic conditions. Are REITs a good investment? Whether REITs are a suitable investment depends on individual financial goals and risk tolerance. They can provide steady income and diversification, but investors must consider their sensitivity to interest rate changes and the potential for underperformance in specific market segments. How to avoid REIT fraud? To mitigate the risk of fraud, it is advisable to only invest in REITs registered with the SEC. Utilizing the SEC's EDGAR system allows investors to verify REIT registration and review pertinent reports. Conclusion: REITs have democratized access to real estate investment, allowing individuals easy entry into a diverse market. They provide steady income through dividends, substantial long-term returns, and an effective hedge against inflation. However, prospective investors must approach REITs with a thorough understanding of their nuances, risks, and market factors. Careful evaluation, ongoing education, and possibly seeking advice from financial professionals will contribute to successful investment outcomes.